True to form, the Reserve Bank Board has moved the official cash rate on Melbourne Cup Day. The first rate cut in more than 2 years represents a complete turnaround for a central bank that was talking rates up just a few months ago. But the RBA was careful not to raise hopes of even lower interest rates, suggesting this was an exercise in fine-tuning built on a lower inflation profile. Here's Philip Lasker.
They queued in the hope of a win in a horse race, but most preferred some help in the rat race. What would you prefer, a win on the Melbourne Cup or lower interest rates?
Lower interest rates.
I'd prefer lower interest rates.
I'll take the cut in interest rates.
And the Reserve Bank came home.
Down. 25 down.
It was the first reduction in more than 2.5 years since the global financial crisis, a cut of 25 basis points, leaving the cash rate at 4.5%.
They didn't feel they needed to continue to have a setting of monetary policy that was contractionary because inflation doesn't look as though it's as big a concern as they thought it might be.
So the board concluded that a more neutral stance of monetary policy would now be consistent with achieving sustainable growth and 2 to 3% inflation over time. The board also acknowledged the role of the strong Australian dollar in keeping inflation in check and signs that the global turmoil was making its mark.
They seem to be a little bit more cautious about the global backdrop, and they see some signs that could be affecting confidence locally. So that's another reason just to bring rates back to normal rather than have them above normal.
Those stuck in the economy's slow lane were thankful for small mercies and urged lenders not to discriminate against those who don't deliver the same PR payoff.
They need to pass on official rate reductions for both classes of borrowers, both households, which is important in terms of impact on overall consumer demand, but also on businesses and business loans.
It's less about the extra money it might put in people's bank accounts, and potentially just that feeling that rates can go down will stimulate a lot of extra spending this Christmas. It will give people that feeling that they can go out and have a bit of a splurge this Christmas time.
And has it given people the feeling that more interest rate relief is on the way?
Clearly, we'd like to see an additional cut.
Clearly, the Reserve Bank would not, because there's no hint of more to come, even though a first reduction in rates is typically followed by more cuts.
The risk is probably that they could do a little bit more, but I think that would require more signs of problems in Europe and in China, for example, and that affecting the local economy.
Unless you believe that was happening, the RBA will sit still, and certainly for the moment we think that they're more likely to sit still for the moment where they are.
The major risk remains the indebted Northern Hemisphere and the possible fallout from every future misstep on the path to a solution.